IVM.
Welcome to All Things Policy, a daily podcast supported by Pragati, a flagship media initiative of the Takshashila Institution. We're a bunch of policy nerds based in Bengaluru, and we like to bring a fresh perspective to Indian affairs and an Indian perspective to global affairs. So grab a cup of coffee, sit back, and join us for today's chat.
Hello and welcome to another episode of All Things Policy, your favorite daily public policy podcast by the Takshashila Institution. I'm Anushka Saxena, a research analyst with the institution's Indo-Pacific Studies program, and I'm joined by Amit Kumar, my colleague from the program. Today, we're going to be discussing some of the latest trends and developments in the Chinese economy. We also did a discussion document for Takshashila on this last month. And now we want to delve into some of our observations and findings for our listeners. Thank you so much for joining me, Amit.
Thank you, Anushka. Glad to be here.
Right. So just to give a little bit of a context and background for our listeners, in the aftermath of the scrapping of the dynamic zero COVID policy, which was a policy the Chinese party state had adopted for the past 2.5 years, which led to the imposition of harsh lockdowns, varied testing measures that led to a lot of reduction in consumer security. So we saw in the scrapping of that policy in late 2022 that there were expectations and speculations that the Chinese economy would rebound. It would witness rapid growth because there was a lot of pent-up consumer demand, like I said, precisely because of the lockdowns and the fact that a lot of the bustling Chinese markets and market entities were closed down. And there was also an expectation that the release of the pent-up demand, along with increased fiscal spending and policy predictability, will lead to boosting of market confidence. It will signal openness. However, despite a relatively positive first quarter performance of the Chinese economy in 2023, China's data for the first half of the year released by the National Bureau of Statistics indicates some systemic weaknesses. And of course, the positive performance in the first quarter can also be explained by a lot of festive and holiday celebrations that had led to a slight rise in, for example, housing sentiment as well. And these systemic weaknesses are not just exacerbated by weak domestic demand, but also persistent challenges with local government debt, property sector fragility, and declining exports and foreign investment. So in that regard, not just during the pandemic, but even before that, we saw that in the Chinese economy, exports became the key driver of growth, right? That's why we refer to China as an export-driven or an exports-led economy. But now, not just the domestic, but also the external demand has weakened because of a host of actions, right? Global demand as a whole is witnessing a slump. And so the scrapping of the policy, the COVID-19 policy, as well as the H1 figures tell us that the demand isn't likely to come back to pre-2019 levels, which means that exports may no longer be the ideal driver of growth in the Chinese economy. And the several factors that are responsible for weak domestic consumption, such as rising unemployment, increased job insecurity, increased income insecurity, and falling property values might have to be addressed, right? Because a lot of the savings of consumers in China are intertwined with real estate expenditures. Of course, that brings us to real estate, which is experiencing a bubble, which is a major risk. China has tried to break the bubble in a controlled manner, but so far there is a steady slump in housing sales, property prices, development investments, and so on. And all of this impinges on the health of other key sectors like banking, right? There is deliberation surrounding a potential fallout in the financial sector because, again, a lot of loans have been let out to the private sector. But of course, any kind of claim that this will lead to a Lehman moment for China, they're misplaced because the Chinese central government has complete control over the banking and the information ecosystem. And of course, there is the increased party state intervention in the market, which remains one of the biggest challenges for the Chinese economy. Because under Xi Jinping, The party state has become increasingly intrusive in a bid to direct capital towards what it views as its national and strategic priorities. And so development and security has become interlinked, and it has bred inefficiencies, wastage, and market distortion, right? And of course, this is also playing out in foreign direct investment and private capital participation, because lending to the private sector and FDI have both remained weak despite whatever encouragement the party state has tried to provide in the aftermath of the scrapping of the zero COVID policy. So, with that kind of tip of the iceberg backdrop in mind, Amit, I'll come to you. And my first question to you is, uh, can you explain to us what is the first factor we should look at when assessing headwinds facing the Chinese economy? You talked about exports being important in one of our conversations earlier. So, how do weak exports impact the Chinese economy, and what should we look out for?
Thanks, Anushka. The thing is that of late, there have been a lot of buzz around Chinese economy in the international media and national media, right? And rightly so, Chinese economy does seem to be facing some strong headwinds, right? And there are several factors go into explaining what the structural problem with the Chinese economy is. And as you rightly said, there are a whole set of factors like exports, weak consumption, the property sector bubble that you talked about just recently, then unemployment concerns, the demographic challenges, and so on and so forth, right? But to discuss about the exports first. So, China for the longest time has been described as an export-driven economy. If you look at the contribution of exports in China's GDP, the net exports have had a disproportionately higher contribution to its GDP compared to the other major and emerging economies. And the other two drivers of the GDP, that is investments and government spending, they also have relatively been driven by export-oriented investments, right? As opposed to completely driven by domestic consumption. So exports does play a greater role in Chinese economy. However, in the recent past, what we have seen is that the Chinese economy has encountered some structural and geopolitical challenges. If I need to put things in perspective, I would say that while exports as a share of China's GDP averaged around 29.9% in the decade from 2003 to 2012, the corresponding figure for the succeeding 10 years during Xi Jinping's reign from 2013 to 2022 has declined by almost 10 percentage points to 20.55%. That's a massive decline, and tells you how what impact this exports has had in the last 10 years on stagnating Chinese economy, right? This challenge has been largely been because of, I think, two factors. I think the first one is the poor recovery of overall global demand, because the global trade levels have still not recovered to the pre-2008 mark. And what we have also seen is that the protectionist policies have gained traction across the world, and it has forced countries to look inward. So, and also this tendency has been accentuated by the supply chain disruption that we witnessed during the pandemic. Pandemic reinforced the anti-globalization and protectionist drives that were already doing the rounds globally, right? Add to it that China's labor costs have been rising, and this has made the labor-intensive sectors slightly unattractive in China. And then when you add to these two factors the heightening US-China geopolitical contestation and China's overt willingness to weaponize trade, wherein it has forced foreign private investors to, force technology transfer or even some sort of economic coercion. This has forced the government and both the investors, the business community, and the strategic community, both to evaluate options such as de-risking and diversifying away from the second largest economy, right? And as a result, what we have seen, the product of this development is that now we are seeing a China plus one strategy where the firms are actively looking for options, right? Given these challenges, the growth projections for the Chinese exports in the near future look grim, right? And it is absolutely unlikely to rebound to the levels that it achieved during the years of China's 9 to 10% GDP growth. And the government has made it clear that they will look towards greater diversification of Chinese export markets in order to boost the exports, and also they'll also look to focus on domestic demand and domestic consumption to compensate for the loss that they have been receiving by the decline in exports.
Right. So, if I hear you right, what you're saying is that the US China geopolitical contestation, especially from the geopolitical perspective, because, that's what I study. So, that competition and contestation has exacerbated what was already a weak global demand number, as well as the fact that countries were already becoming extremely protectionist and deglobalizationist, if that makes sense. And of course, then if that's the case, this is likely to continue because the US China economic and technological contestation isn't going anywhere.
Right.
And it's not just the US and the EU whose demand China has to compensate for, but also countries like Japan, that is increasingly adopting a policy of friendshoring and bringing back its companies that were previously operating in China to either Tokyo or to countries in the ASEAN, and Australia, which is sharing a contentious trade relationship with China. And so it does really seem as if China will have to adopt a model that shifts away from export driven
Right.
to domestic consumption driven.
Right.
On that note, Amit, let's come to the elephant in the room, which is indeed domestic demand, right? So, of course, China has been making efforts, two-pronged efforts, not only to bring external demand back on track, but also, like you said, to kind of push the weak domestic consumption sentiment. And what has been the challenge there? What's the backdrop, and what does the future kind of look like?
So right, so what happened that because of these declining export figures, the Chinese leadership was worried, and at some point of time, they had to make a decision wherein they wanted to make their economy less export oriented, and that was when they came up with the idea or the policy of dual circulation, right? Dual circulation strategy that seemed to focus or rely on domestic demand and consumption as the primary driver of the GDP. So this need to rebalance economy away from exports has brought domestic consumption, China's domestic consumption to greater focus for the leadership. China's domestic consumption pattern presents an interesting case, and depends on how you look at it. But historically, as compared to other advanced and emerging economies, including India, where domestic demand and household consumption contributes to at least more than 70% of the economy. I mean, it ranges between 60 to as high as 80% in some of the advanced economies. The corresponding figure for China has hovered around 55%. And you may add to it a few percentage depending upon which sectors you include into it. But this is usually the average where the China's domestic consumption as a proportion or as a driver of GDP has likely remained, right? The larger than usual contribution of exports has dropped contribution from domestic consumption. Therefore, you saw strategies like dual circulation and other means to push domestic demand. There were also efforts to boost regional integrated development, and so that demands could be boosted. But these efforts have yielded limited success so far. Moreover, boosting household consumption's share in the country's GDP is as much a challenge for the Chinese as it's an opportunity, right? Because what you saw during the zero COVID, dynamic zero COVID policy during the period wherein it was implemented had drastic implications for consumer sentiment. And the consumers are not willing to consume and spend a lot of money on the demand, which would in turn drive the Chinese economy. And want to give you a context to this. What we have noticed is that consumption as a percentage of GDP has fallen from 54.5% in 2021 to 32.8% in 2022.
Wow.
During this period where zero COVID policy was in place. This took a toll on the consumer sentiment, and it's despite a short spike in the pent-up demand, as you pointed to earlier at the beginning of the episode. There has been consumer confidence continues to remain low, mostly owing to and the real estate sector is a big contributing factor into this, which accounts for like 70% of the household wealth. And again, you also have burgeoning unemployment rate. So, given all these factors, the consumer sentiment, the slump in the property market, parties or the government crackdown on the property sector, focused on bursting the property bubble, and the increasing in unemployment, there are less signs that this domestic consumption could also be revived in a manner that the Chinese leadership wants, right? And thing is that the Chinese citizens also have their money parked in corporate bonds, right? Which again are linked to investments in property sector. And when they are not getting returns from those bonds and the bonds are likely defaulting, it means that the disposable incomes becomes more dear to the consumers, and they are less likely to spend it. So these are the challenges that the consumption strategy or the consumption as a driver of Chinese economy faces right now.
Right, right. And I think so far the government's response to support consumption has also been limited to providing supply side incentives, like I said, to boost sales of consumer and household goods, automobiles, property and services, like leisure, culture, tourism, so on and so forth. And through the Common Prosperity Campaign, there is also an incentive to provide subsidies and payroll incentives to MSME directors and other entrepreneurs, right? So that they can keep their employees on a consistent payroll. And the hope is that that kind of will create enough income and stimulate domestic demand. But it's not worked so far. And the failure to kind of provide demand side intervention might likely continue to weigh heavily on consumption.
That's a very valid point, because all of China's the Chinese leadership measures have been focused on supply side rather than demand side. And I think we can discuss it further, but I think there's a worry that a demand side intervention could likely lead to increased sovereign debt or the government debt that has already become a challenge for the government. Yeah.
Stay tuned to All Things Policy. We'll be right back after a short commercial break.
Right. And of course, we'll come to an assessment of debt. And of course, like you said, the fact that a lot of the savings are tied up in the property sector a little later in this episode. But I also want to assess side by side with domestic consumption the other demographic challenges that are making consumption untenable and are impacting growth overall. You mentioned that labor force is getting more expensive. At the same time, I talked about how unemployment has become pervasive. So would you have any statistics or data to indicate what kind of a demographic challenge China is currently facing?
Of course. So previously this year, I think in the month of May, June, the youth unemployment rate in China hit a record 21.3% this year, right? And according to what the stats that National Bureau of Statistics gave us, right? What they also did was just a month later, in August, I think, they announced that they'll stop publishing the age group specific unemployment data from August, September onwards, citing the reasons such as they need to improve and optimize labor force service statistics. I mean, that was clearly a pressure that the leadership was reeling under, and the unemployment rates were skyrocketing. And in a way, it was an acknowledgement to the challenge, the unemployment challenge that the policymakers were facing, right? And now, if you and this already paves into the objective of expanding domestic consumption, which will it already has a lot many challenges like consumer sentiment and other things, but unemployment will also cater to it, right? And now, if unemployment rate of youth unemployment rate or unemployment rate in general is rising, you'll have to also see what impact does it create on China's age dependency ratio, right? If you have to look at, it's a ratio of younger people to the people who are the working age population to the non-working age population, that is below 14 years and above 64 years. And if you look at this statistics, that age dependency ratio in China has risen from 37% in 2010 to around 45% in 2022. And now that effects of China's one-child policy have kicked in, and we are now seeing that the birth rates have declined for the first time in the last 60 years. We are going to see that this age dependency ratio will continue to increase. But if you add this rising unemployment, like if you view this rising unemployment in the context of rising age dependency thing, you see that China finds itself in a very precarious situation, and it will be a problem.
Right. So this is essentially like a double whammy,
Right.
where more and more older people and people below the age of 14 are looking to be dependent on the working age population. And even as the working age population is declining and fewer younger people are able to find jobs, and of course, in a while, in some years, maybe in the next decade, there will also be fewer younger people to seek jobs because there is a declining
Right.
birth
Exactly.
ratio, right?
Right.
So this is clearly a vicious cycle. And of course, this again brings me to the other elephant in the room, the other sector, apart from exports and domestic demand, that is so interlinked with all the other key drivers of the Chinese economy, which is real estate. And so, what is this property bubble that everybody, including us in this episode, keep referring to, right? Why is the real estate sector so important when we don't really hear about real estate in this important a context in perhaps other countries?
Right. I rightly said. So real estate has been a major problem for the Chinese economy for the past 20 years or so. So the thing is that this property bubble started to develop in, I would say, around 2008. But before that, for our listeners, the property and allied sectors in Chinese economy accounts for around 25 to 30% of the country's GDP, depending upon how you count it and which sectors do you include, allied sectors do you include, and which you exclude. Okay, so with that in context, what happened in the aftermath of 2008 financial crisis was that China shifted its monetary policy stance from prudent to proactive. And as a result of this, what happened was that you saw a continued flow of cash stimulus and an emphasis on increasing property ownership. And this led to a rapid expansion of an already heavyweight real estate sector, which started happening somewhere around 1990 3 in the mid 1990s. I'm not sure. I don't recall the year exactly. So what this model led to a lot of wasteful expenditure and speculation, resulting in the creation of an unsustainable bubble. And bursting this property bubble in a contained manner and tackling speculative practices in the market has been a regulatory challenge for the Chinese leadership for a long period of time. But the leadership has tried to stay away from it, fearing that it would have a cascading effect on other sectors of the economy, as we discussed. And so leaders have not been very keen on tackling this issue.
But of course, Xi Jinping has taken it upon him.
Right. So Xi Jinping thought that he is the rightful person and who does not have to fear for consequences, and he's the rightful man to do the job. So in 2016, the policies shifted, and Central Economic Work Conference in December, which was held in 2016. The Chinese authorities issued a warning that homes are for residential use and not speculation. This was a major policy shift. And then in 2020, you saw that the central leadership imposed the infamous 3 red lines regulations. That was essentially to curb the access to capital that these developers had. What this essentially did was this resulted in several property developers defaulting on their loan because they could no longer have access to the capital because it was restricted and unless they maintained certain capital regulations that was mandated by the central leadership. And now what we have seen is the unraveling of a crisis in the property sector, wherein there have been, in regular succession, property developers have defaulted. People have been losing out money because they spent it so much in buying property, but could not get a return on their property, or their homes were not delivered to them. And this has also had a major fallout on even the local government financial vehicles or the state government's pool of resources. Look, in China, the state governments are, or the lower rung of the government apparatus of the government is the one which is largely investing in the infrastructure projects and keeping the Chinese economy on the run. But because the property developers have defaulted, and because a large chunk of resources for these state governments and the provincial governments come from these developers, and the investments are by sale of properties to these developers, their resources have slumped, and add to it the stretched expenditure that they had to go through during the pandemic. So this has clearly burdened their resources as well, and just shows you is that property bubble has been having or has had impacts on other sectors as well, and the any alteration that you would like to have in the property sector will not be limited to that sector itself, but have a glaring impact in other sectors as well.
Right. I think that makes a lot of sense. And, some of the most famous examples of this playing out are Evergrande and Country Garden. They've been filing for debt security. And like you said, any impact in the real estate sector is linked with other sectors in the economy. So the slump in housing demand has led to dipping savings and rising mortgages. And of course, all of this is to reach one aim, one goal, which is to deleverage the over-leveraged property sector. And of course, this is going to lead to defaults on debt, unfinished projects, so on and so forth. And you mentioned the severe impact this has on local government debt. And I think you rightly pointed out that it's a structural issue intricately linked to the real estate crisis. But again, just quickly to go through some of the statistics for our listeners, I think currently the outstanding or the off-the-book debt which has been accumulated by the local governments has been around $5.1 trillion. And this is according to the Ministry of Finance's numbers. So this tells you that cumulative debt represents around 74% of the national GDP. And so now as property firms are defaulting, so are local governments, because any default in the property sector means lack of revenue for the local governments to finance other projects. And so, of course, this crisis is likely to continue, and there is no way that any debt clearing plans will go underway, because Xi Jinping is also amassing a lot of power through centralization, while at the same time arguing that local governments are required to innovate and deliver on projects on their own. So it's both a political and an economic conundrum.
And the fact that local governments have been central to countries' investment-led growth. And if the LG, FVs, the local government financial vehicles keep on defaulting, there is likely to be an impact on countries' investments, right? Which I think the leadership has been pushing to have more investments, to increase investments, but we haven't seen likely an increase in the investments so far. And so this, so you see how a chain of events impact in the entire sector, wherein the defaulting property developers have led to a default amongst the local government and the provincial governments, and that in turn is now impacting the investment cycle in China.
Right. That's very interesting. You talked about the domestic investment, but what about foreign investor confidence? I mean, we did discuss how exports have become a challenge, and there is also a de-risking and a China plus one sentiment across countries. So are governments now going to be expected to also nudge alignment across the private companies that originate from their territories to kind of pull out their businesses from China, or has that sentiment been pervasive in the private sector already, and a government nudge is not really required?
So this all started with the nudge from the U.S. administration, right? When beginning from the period of Trump's administration, wherein the U.S. administration quite nudged their business community and national business community and their European partners and the European companies. But we did not likely see a change on that front, when we saw that the companies were slightly resistant to respond to the nudge that the American administration was keen on, right? But lately what has happened is that China has, under Xi Jinping, he uses his favorite maxim when he alludes to economy. I mean, he repeatedly points to that there's a need to rebalance security with developmental needs. And in the succeeding periods, what we have seen is that China has come out with legislation such as on cyber laws, on espionage, etc., wherein it has tightened, where it has come out with a very vague definition of national security, and has tightened what could be construed, tightened the definition of what can be construed as national security and what could be something that is business as usual for the foreign companies operating in the Chinese territory, right? So now, of course, what you have seen is that various chambers of commerce from representing their respective countries, America or the British or German, and even EU, they have come out with their business confidence report, wherein they have said that there are the number of people who are likely to now shift or diversify has increased significantly, or at least to an extent, in across the board, right? And this has led to rethinking over diversification and de-risking narrative that did not get a big purchase in its initial years, but has now been has got some momentum now, wherein the companies are actually thinking that de-risking with China plus one strategy could be something that they should look for.
Right. That's very interesting. And you mentioned the business confidence survey or the business climate survey reports by the EU and the AmCham, respectively. And they've also declared revenue losses year on year. And 64% of the businesses, which is the highest on record, have reported that doing business in China has become more and more challenging in the past year, which of course is attributable to what you said, increased regulatory interventionism. Because, it was a couple years ago, I think in 2019 or 20, when Xi Jinping said that there has to be a crackdown on uncontrolled growth of capital, right? And so this is a consequence of all of that, not just domestically, what we see with Alibaba or Evergrande, but also with foreign businesses, which is why we see that foreign investment, especially American foreign investment in China, has gone down from $19 billion in 2018 to just $1 billion last year. And of course, European countries, most of the European businesses are also likely to follow suit. But at the same time, the de-risking and the detachment strategies have kind of not yielded any results, because countries are now increasingly realizing just how interlinked their economies are with China. Thank you so much, Amit, for your insights. And I think I'd like to conclude the podcast by saying that a study of the Chinese economy in this manner is required, not just as a subject of its own, but also because, as I argued just a moment ago, that a lot of the other economies, including India's, are deeply interlinked with the second largest economy in the world. And any fallout in the Chinese economy, most of which has been really controlled till now, but if it goes out of hand, will impact our own. So thank you once again, Amit, and thank you to our listeners for tuning into another episode of All Things Policy.
Thank you so much, Anushka. It was a pleasure being here.
If you liked our show, don't forget to check out other interesting podcasts on the IVM network. You can tune into them on the IVM Podcast app, ivmpodcast.com, or wherever you listen to your podcasts. You can also follow IVM on social media. The handle is @IVM Podcasts on Twitter, Facebook, and Instagram. And hey, if you'd like to dive into Takshashila's research on technology, strategy, and economic affairs, check us out at our Twitter handle @TakshashilaINST or our website takshashila.org.in.